We were having a great chat back there. Um, where to begin, really? We've covered so much on private credit at the moment, but I think maybe we'll go out global before we come back regional, particularly for you, Sami. And if we look ahead, how we're seeing these private markets evolve on a global scale, give us your sort of take on that first off.
Well, we're looking at it from the perspective of the allocators in this region, who are quite significant, who've been building up large portfolios of private credit in the US, in Europe, and more so in Asia. We're seeing, obviously, sort of keen interest in diversification amongst different asset managers. Also, diversification in terms of who's funding that business. So we're sort of, ADCB is one of those sort of funders, but they like to sort of diversify their risk to a multitude of banks. And we're also seeing different types of asset classes. So moving from sort of what we call sort of middle market PE-sponsored credit to smaller non-PE sponsored, to tech company loans, to infrastructure, to real estate backed, and so on.
So Stan, you've got at last count, obviously you can update us, about $66 billion US. Not an insignificant amount to be in control of. You've evolved, though, during that time with that cash from a single strategy boutique to a multi-strat global manager now. How are you integrating this private credit into that and also other private strategies?
Yes, for decades we've been managing public equities across the globe, really seeking to produce mid-teens returns for our clients. And in 2022, we decided to diversify the firm and enter the credit markets in both public credit, private credit, and in structured credit. And when we were looking to acquire a firm, we were looking for the skill set with the ability to produce mid-teens type returns for our clients. So in other words, we could present compounding on the equity side and great cash flows on the credit side to help our clients, help the asset allocators who are allocating through us, and improve the overall diversification of the firm.
And Justin, you've seen things from a very great height from the US Treasury point of view. But when we think about that private credit platform, it's been growing very quickly. But if we think about how companies have been accessing that, particularly the mid-sized ones, in terms of when we look at that segment of the market versus traditional bank lending and public bond markets, how are you seeing that evolving?
Sure. It's evolved hugely over the last decade. Private credit globally has filled a huge need for private companies. If you think after 2008, as banks had to reduce their balance sheets, if private credit had not been available, growth in the U.S. and globally would have been a lot slower. It's really played a vital role in the growth of the U.S. and other countries. And what's been interesting to see happening is that as the market has matured, it's more and more competing with traditional broadly syndicated loans and high yield, which I think has been good for companies. If you look over at Asia, it's really filled a need over there, especially over the last few years, especially as high yield markets haven't been issuing as much. Private credit has been very important over in Asia.
So there's no doubt, obviously, as you said, it's been adding that very necessary level of liquidity. Obviously, the liquidity within the US markets is deeper, Sami, but we do have a fledgling market here, and maybe a slightly different approach at the moment in terms of banks such as yours partnering on the private credit side with private equity managers.
So we obviously have a very active fund finance business, which we developed a couple of years ago. And so obviously one of the ways we partner with private credit is we provide different types of what we call fund finance. That takes different forms. For example, we do loan-on-loan leverage, We do what's called sort of NAV financing against LP stakes. We do what are called subscription line financing, which is lending against uncalled capital commitments. And we've managed to grow our book significantly over the last few years. So that's the obvious. When we talk about private equity, we are also an active lender in this region to sponsors that are either growing their businesses. For example, in data centers, we recently financed a company that was sort of co-sponsored by KKR in the UAE. We've also financed the acquisition of Network International by Brookfield. So we are working sort of hand in hand with private equity. And where that's going is potentially to the smaller, more middle market type companies where banks and private credit can sort of work together in different parts of the capital structure. So what I see potentially happening in the future is we sort of work where the bank takes the senior debt and the credit fund takes, for example, a more junior piece in the capital structure. I see that. And people have talked about future flow partnerships where banks sort of help originate product or lending opportunities for private credit. We haven't really seen that in the region. I'm not sure how quickly that will happen, but it's something that's definitely discussed.
Justin, I can see you nodding away there.
Sure. No, I think that's exactly right. I mean, I think one of the most interesting parts of private credit are these bank partnerships, and it's something that we've been doing sort of extensively. In Europe, we now have partnerships with 50 banks to source private credit, and I think it'll be a big part of the future of the private credit markets.
Stan, do you want to add to that?
Yeah, from our perspective, we're using the banks much more around structured credit, around the warehousing and the lending to create things like CLO offerings for our clients. And we play more in the lower middle market direct lending space, so we're not seeing as much of that in terms of origination coming from banks. That's where the banks aren't participating as much, and we're stepping in to provide the capital that these small businesses need in the United States.
And you're kind of touching on access to capital there, and I wanted to build on that with you, Stan, because there's no doubt there's been a wave of innovation for access and liquidity as well in secondaries. Which structures do you think are genuinely improving that access at the moment and perhaps liquidity to private markets?
Yeah, I think that's very interesting in that there's different forms of potential liquidity that you can get in these markets. Probably the most transferable in liquid terms is the secondaries market, which is very robust in the United States. The LP can actually transfer their ownership interest to someone else. I'd say the second is continuation vehicles. That's more the GP putting things into continuation in a position they want to hold. So that has a liquidity component to it. And then the third option, and we actually have one of these funds, are the evergreen options, which are semi-liquid. And they're not as liquid, and they do have that liquidity mismatch because you can have, if you have, say, a 5% quarterly gate, investors can ask for 5% out each quarter. And just because they're asking for 5% out each quarter doesn't mean the underlying asset is liquid. So you have to manage the portfolio to have a combination of liquid assets and illiquids to be able to meet those drawdown demands. So it's a delicate balance.
Yeah, and I wanted to come back to that challenge. We can dig in a bit more there. And Justin, with you, really the borrowers and investing, supporting that growth. How do you manage that? And what innovation are you seeing, as well as waiting to be able to manage that sometimes tricky relationship?
Yeah, it's just very, very important that you match liquidity, as we were just talking about. And I think the current structures, most semi-liquid structures have 5% liquidity a quarter. For what we do in private credit, that works well. There's natural amortization. But I think the risk is that investors, when times get tough, they'll want more than 5% a quarter, even though you've been, clear that there's just 5% a quarter. And if they ask for more than 5% a quarter and can't get their money back, they'll say, well, a manager is gating. even though it's not really gating, because gating is when you do something which, when you tell people they can't have liquidity, which you've said they can have, but here it's semi-liquid. And so I think there's just this reputational risk around it, even if even if you've been very transparent. So I think managers just really have to communicate, make sure investors know that there's this limit of 5% a quarter. Otherwise, there are these you risk reputational issues.
Yes, you have to be very clear when they're going in, obviously terms and conditions. And it's something we've touched on about all kind of morning and afternoon. And I'm just going to get your point of view, because you're two massive investors as well, is the sort of slight mini maelstrom, let's call it, about private credit, and the fact that, suddenly there was this deep concern about it. And we've heard many people, not least BlackRock first thing this morning, saying, I think that's one of the biggest mistakes in the market. So maybe I'll carry on with you there, Justin, in terms of where we are now with private credit at the market and those private markets, and let's call them how safe they are.
Sure. Well, I'll make two comments on it. First, I think if you're being honest about private credit, you have to admit the markets are a lot more crowded than they were 5 or 10 years ago. We got into the business in 2013. And there's a lot more capital chasing deals, and spreads are lower. So, that's a backdrop, I think, for private credit. And my sense is for down the middle, upper mid-market, core mid-market private credit, returns are going to be lower than they have been historically because the market's more crowded. That said, the two deals which everyone is focused on, First Brands and Tricolor, I don't think it's really fair to read across from those to traditional private credit, because basically there was fraud in both deals. And unless your thesis is fraud is widely spread in private credit, I don't think those two deals are particularly instructive.
Yeah, people were suspicious because it wasn't listed and didn't think the regulation was necessarily there, Stan. I think that's an old-fashioned concept. But Stan, from your perspective, what kind of questions do you get asked?
We often get asked about the cockroaches that Jamie Dimon referred to, but when we look at our business in across the U.S. high yield market, and we go down into the CCC market as well, we haven't seen default rates increasing. We've heard about defaults increasing, but we actually haven't experienced it yet in our own book of business. And then when you go to extend into the BSL market and CLOs, we're also not seeing that. And that's where First Brands actually did have an impact in the CLO, but CLOs are broadly diversified. And then in private credit, we're seeing the economy in the US still being fairly robust and not seeing as many problems there. So there's a lot of talk about distress or the forthcoming recession, but we're not seeing it at this point in time in our book of business.
No, and in some respects, it can be absolutely safer than necessarily just investing in the market. And Sammy, bringing you back into that, obviously we talked about the depth of the market and where we are here in the Middle East, here in Abu Dhabi. Do you think there's a process of education with private debt and people investing in it in this region, or do you think they've got it? It's just maybe the opportunity to invest isn't quite there yet?
To invest in local assets, you mean?
Yeah.
No, that's interesting. That's something we've been keeping our eye on for the last really couple of years since I've been in this country. We're certainly, as ADCB, obviously a large corporate lender in the region. We're also a middle market and SME lender. These are regulated businesses. They don't preclude the existence or growth of the private credit industry. I think to just sort of answer that question, one has to sort of take a little bit of an understanding of what some of the key, if you will, drivers and enablers are. One is, of course, a massive capital investment program that they've embarked on in the UAE and in Saudi Arabia. That's created, of course, that's driven, if you will, by local allocators who have become obviously very sophisticated along industry verticals and specialization. And that's created, of course, national champions that are able to compete nationally and internationally. And so this, in addition to, if you will, the legislation, regulation that's been introduced, everything from visa rules to securitization regulation to many other forms of regulation, has introduced, if you will, a very positive environment for private credit and private capital to thrive. And so we're seeing we're starting to see a lot of deployment, both in larger type companies like you probably heard of Property Finder, raised obviously both structured equity and then subsequently raised structured debt, but also larger companies, as I mentioned before, like Global Data Hub, which raised private capital and other sort of large companies in this region. So we see certainly an opportunity for growth equity. We see that developing, and that comes, as I said, in different forms. So it could be sort of minority interest structures, debt plus warrants type structures. And we also see infrastructure type, either social infrastructure like education companies or digital infrastructure like I mentioned before. And also we see the use of sort of securitization technology, both by private credit and banks, to create more capital for smaller growth companies.
And I'm guessing as well, we won't drill down on it now, but the increasing public-private partnerships as well. There'll probably be a role tucked within there for maybe a bit of private credit as well. But you also mentioned something else which is interesting, which I want to take out to Stan and Justin as well, and that's the guardrails, the regulations. Is there anything that you think should be out there, or anything that you see that is out there that you think is keeping that market safe or could keep it safer? Maybe Justin, I'll start with you.
You know, I think regulators overall are being quite thoughtful and careful. I mean, when they're accepting retail or private bank money, you know, it's being quite carefully regulated. Obviously, insurance money is obviously you know, heavily regulated. I will say on the fund technology side, I think there are what's a very positive development is this move towards evergreen structures, sometimes with runoff sleeves, sometimes really truly evergreen, and that, you know, allows funds to get invested much more efficiently and then not have the ramp up and ramp down periods. And so I think that's a sort of a good development in the space.
Stan?
We think about it in terms of the evergreen structures as well, particularly again a tender offer fund or interval fund structure, an LTIF or an LTAF, because the regulation around trying to get an illiquid asset to a mass affluent or to the retail market, the democratization evolves. There's different regulatory regimes in each location around each specific jurisdiction. And even within the U.S., you have to be a qualified investor or accredited investor type fund or not, and then how that gets pushed through. And then when you tell someone that they have a 5% gate and they say that gate doesn't apply to me, and they file for litigation, it can cause issues. So I just think the more that the market develops and the more these vehicles become commonplace, and the regulatory regimes from Singapore to the UAE to Europe to the US, the more that they're aligned around these type of vehicles, the better it will be for accessing the markets in total.
Well, I've got you both in the hot seat because you're so experienced. Sammy, I know you're not allowed to predict the future, but you've already given us a really good overview of where ADCB is looking in terms of where you think private credit is going to be utilized possibly. But Justin, if we're looking ahead to 2026 and beyond, as you said, maybe the returns are being compressed. Yes, there's more competition. But if somebody out there is thinking of dipping their toe into these private markets that they haven't been in yet, what do you think we should be looking for in 2026 and beyond?
Sure. I would look for areas of private credit that are less trafficked. I think there are great opportunities in private credit, especially around bank partnerships for really attractive risk-adjusted returns. You know, one of the nice things about the asset class maturing is that it's not all one thing anymore. There are subcategories of private credit, and for sophisticated investors like you have, in this region, I think there are lots of interesting opportunities if you really sort of can parse the private credit markets a little bit.
Yeah, so it's not just exclusive to institutions, which is what I think a lot of people are thinking. There is the possibility for retail involvement as well. Stan, from your perspective, 2026 and beyond, where are you seeing private credit, maybe the hotspots and maybe things to avoid?
Yeah, I agree that there's spots within private credit that look more attractive. We think that lower middle market private credit looks very attractive. Some asset-backed financing looks very attractive. But if you look where spreads are today and how tight they are in the U.S., the most attractive thing from my perspective is actually in the CLO equity realm, because you can structure the credit, lock in your borrowing costs, and then when spreads widen, take advantage of that and get a really nice return for your investors with a cash-on-cash return paying out quarterly. So I would lean more towards structured credit over private credit at this moment.
That's how they do it. And Sammy, I'm going to leave the last question to you, a little bit of a one that we've been hearing all along this morning, and that's AI and technology within the bank. What kind of systems and processing? We hear in the last two panels how they're being integrated into those systems for productivity gains. Is that something you're a big believer in, that you're adopting? We are in Abu Dhabi.
Yeah, it's funny you ask. And I didn't place that question, but we are obviously, with the size of our portfolio and our exposure going up, we're obviously making sure we have sort of state-of-the-art credit monitoring systems, and we are in the process of sort of upgrading all of that as we speak. And of course, AI and sort of enabled sort of technologies have started to seep into this business. So yes, we are looking at AI more from a credit monitoring perspective, and eventually it'll be used much more broadly, I think.
Yeah, brilliant. And I can definitely guarantee I didn't plant that question. In fact, I didn't ask you if you could answer it, but thank you so very much for indulging me today. And gentlemen, no doubt bringing your depth of experience and market knowledge to this panel today to talk about an asset class that is definitely looking more interesting for the individual investor as well as the institutional investor. So thank you so much for joining us today. Sorry about the music. I think we should be dancing out to this one. But thank you very much. Justin Muzinich, Sami Tabara, and of course, Dan Moss joining us here today. Gentlemen, thank you so much for your time today. It's been an absolute pleasure. Thank you.